Hello, everyone, and welcome to the webinar today. My name is Alexandra Alvarado, and I'm the Director of Marketing and Education here at the American Apartment Owners Association. And today we have a topic that we haven't covered before, which is the 721 exchange. I know most of you have heard about the 1031 exchange. This is going to definitely be something a little new that has to do with 1031 exchanges. So I'm very, very excited to have with us today for the first time Dwight Kay, who is the CEO and founder of Kay Properties LLC. And he's going to go over exactly what that 721 is and how it can fit into your strategy. So before we get started, I just wanted to, let you all know that as usual, we are recording this entire thing and we are going to have some time at the end of the presentation for questions. So please put your questions in the question box so that we don't miss your question. And then also you have access to the chat if you just want to put in a comment, but the questions that are put in the question box will be prioritized over the chat. So please be sure to input your questions there. Also, just want to tell you a little bit more about Dwight Kay. He started as the founder and CEO of Kay Properties and Investments and has now had over 2,270 investors nationwide that have invested in more than 9,100 1031 DST 721 exchanges and real estate investments. And K Properties is now one of the nation's leading 1031 exchange real estate investment firms, and they specialize in Delaware Statutory Trusts. Mr. K established K Properties with an emphasis on providing real estate investment options to high net worth individuals looking for passive real estate ownership. And many people have said that Mr. K is responsible for revolutionizing the 1031 exchange landscape. So we're very excited to have an expert like this with us today to go over this strategy that I think is going to help a lot of you make some decisions in the future. So with that said, Dwight, thank you so much for coming to speak to our group. We're really happy to have you here.
Absolutely. Alexandra, thank you so much. Really appreciate this opportunity to present with you and to your members at the AAOA. So really appreciate this. Thank you.
Yeah, absolutely. And I also wanted to mention, actually, before you start, Dwight, I almost forgot. We do have the free Delaware Statutory Trust Toolkit. So that's something that you get as a part of being on this webinar today. We will ask this question also at the end in case you don't get a chance to answer it right now. But basically, it includes a subscription to the 1031 DST Digest magazine, a copy of the Delaware Statutory Trust Properties book, which has a bunch of different options for you, and also the free current DST 1031 exchange property menu. So if you say yes to that, we will prioritize you and send you that free toolkit after this webinar. So again, I will pull it up at the end of this webinar one more time. And if you're like on the call or you can't get to answering the poll right now. So let me go ahead and close that out for now. And now, Dwight, I will let you take over from here.
Perfect. All right. Thanks again, Alexandra. And thanks everybody for joining us today. Really appreciate you taking the time out of your busy schedules to jump on and learn more about the 721 exchange UPREIT as an exit strategy for 1031 exchange investors. We're going to jump into kind of what that is, the 721 exchange, what some of the problems are that investors have that leads them to look towards the 721 exchange as a potential solution for those problems. And that's what we do at K Properties and Investments, is help our clients that have a specific set of problems, with their apartment properties, their commercial properties. Like Alexandra said, we've worked with over 2,300 investors that have done 1031 exchanges into Delaware Statutory Trust or DSTs and 721 exchange offerings over the years. I've been personally doing this for nearly 2 decades, working with 1031 exchange investors, doing DSTs and UPREITs. And so, clients are coming to us throughout the country, specifically to help them with problems that they have as they're looking at the properties that they own, and they may have had some significant capital gain in those properties. And if they're, the problem is if they just sell it outright without a 1031 exchange, they're going to be hit with a pretty massive tax bill. And so that's, really the first problem that a lot of investors come to us, talking about. And that's, whether you own apartments or commercial properties or, farm and ranch land or self-storage buildings or medical buildings. We've seen it all. We've done all different types of 1031 exchanges and subsequent into Delaware Statutory Trust, and then subsequently into 721 exchange vehicles. So that's what we do at Kay Properties. And before we jump in here, I'm going to talk about some risks and disclosures. This isn't tax or legal advice. We ask you please do speak with your CPA and attorney. Although we have many attorneys and CPAs and accounting people on staff here at Kay Properties and at our sister company, we encourage you to speak with your own CPA and attorney, talk with them for personal tax and legal advice, because we can't provide that for you. DST 1031 properties and 721 vehicles are only available to accredited investors, which is generally defined as having a net worth of over $1 million, excluding your primary residence. And real estate has risks, right? Just like the apartments or commercial properties that you own in your town, in your city, in your state, there's no guarantees that tenants are going to pay rent. There's no guarantees that property values are going to go up. Sometimes tenants don't pay rent. We all know how the eviction moratorium went during the coronavirus pandemic. Hit a lot of apartment landlords very hard. And then we also know that property values can go down. Okay, so just like your properties, DSTs and 721 properties, there's no guarantees. It's real estate. You could lose your money investing in real estate, DST, 721 vehicles. You could lose money. We're going to walk through some specific ways that we've helped our clients over the years mitigate the risks inherent of real estate investing. We're going to walk through some of those, but there's no guarantees. So prior to investing, read each offering's private placement memorandum. We call it a PPM, and that's going to discuss the business plan of the offering. It's also going to discuss the risk factors. So we encourage you to read that. Quick overview before I jump into the 721 exchange. This is our team, Kay Properties Investments. Again, started doing this personally nearly 2 decades ago, working with DSTs and 1031 exchange investors. Wrote an article on the 721 exchange, is a lesser known cousin of the 1031 exchange. I think it was in 2008 or 9. So, been working with this specifically for quite a long time. At Kay Properties Investments, I realized quickly that there weren't any specialists in this space. Nobody was doing just DSTs, just 721s, just working with 1031 exchange investors. Everybody that was doing it a little bit, maybe they did 1 or 2 every few months or once a year, they would help a client with the 1031, but they were selling stocks, bonds, and mutual funds, life insurance to those same clients. They're financial advisors. Problem is, there's no specialty there. And so I set out to, become the specialist in this space, and been very blessed along the way, and, ended up growing the largest group that specifically works with 1031 exchange investors doing DSTs, 1031, 721s. Nobody works with more clients than Kay Properties. And again, we're very blessed. We're very fortunate to do that. It kind of started with the specialization nearly 2 decades ago. In 2008, I purchased my first DST personally as a cash investment, a test investment, my wife and I. And, fast forward, I wrote the first book ever authored on Delaware Statutory Trust properties for 1031 exchange investors. And there's a 721 exchange chapter in that book. And so I wrote the first book that ever existed. And again, that's the specialization that I wanted to create for our investors and have a deep, deep knowledge pool in one specific thing. Didn't want to be doing all different types of things like a lot of others still do. But one specific thing. And so, we've got at Kay Properties, our team members collectively have over 340 years of real estate experience, and we have over 2,270, it's 2,300 plus now, of clients nationwide, right? We're based out of Torrance, California, so Los Angeles. We invite you, come see us, we have clients in our office all the time at our headquarters here. But we're licensed in all 50 states, and our team members, our clients are throughout the country. Many different clients all over the country, all walks of life. selling properties, looking for a specialist to help them with their 1031 exchange into DSTs and subsequent 721 exchanges. So we've helped our clients invest in over 9,100 DST investments nationwide. And we've participated in more than $39 billion of real estate investments. Okay. And what that does for our investors is it provides a level of specialization and expertise and knowledge base that just doesn't exist in the DST space. You know, we've been working with the DST sponsor companies, and these are the groups that go out and buy the property, put it together as a DST, and allow investors to exchange into it, and then manage the property. That's a Delaware Statutory Trust sponsor company. We have over 25 of those DST sponsor companies that have posted their DST investments and 721 exchange, exit strategy investments on the KPI1031.com platform. And KPI1031.com is our kind of marketplace where sponsors are putting offerings on. We're going through many offerings prior to them being posted on the marketplace. A lot of them don't make it on there. We reject a lot of the kind of higher risk asset classes. We'll kind of get into that a little bit more, but a lot of our clients are at or near retirement and they don't want to take on any unnecessary risk. And so going into a commercial real estate asset class that has higher risk historically than others is not something that we want to be involved in. But at K Properties, again, our specialization, over 2,300 clients, 39 billion of DSTs. My first DST I bought was in 2008. Since then, I've invested in over 90 different Delaware Statutory Trust offerings, 90, with many different real estate sponsor companies or DST sponsor companies. And so we know the backstory of these groups. We know who actually does a good job, who doesn't, who we would never invest with personally, and we don't put our clients with them. And so that expertise is what brings our clients to K Properties that, where the clients want somebody that really has been there and done that. There's a handful of groups out there that have kind of copied our business model, and it's funny, their websites look the same as ours. They kind of do all the same stuff. The founder wrote a book, but they sprang up 2, 3, 4 years ago, right? They don't have the backstory. They don't have the history. Great people, but they just don't have the experience, and that's what we bring to the table. A lot of times we liken it to if you're getting a knee surgery, you don't want your general practice doctor or maybe the guy that just got out of medical school to do that surgery. You want the doctor that's been doing it for 20 years, has done thousands of knee surgeries. That's who you want. And that's what our clients come to us for. So KPI1031.com, log in there. You'll get access to the marketplace of all these different DST sponsor companies. As well as we have a sister company, Cove Capital Investments. That's a Delaware Statutory Trust sponsor that my partner and I, Shay Lapin, who's the president of K Properties, we founded Cove Capital to provide a specific niche in the DST space that wasn't being fulfilled, and that's debt-free DSTs. But if you go to the KPI 1031 marketplace, you get to see the entire industry that we have on there of DST sponsors with 721 vehicles, offerings that have leverage on them, offerings that are debt-free. We have zero coupon offerings. And you get to kind of compare and contrast and make your decision for yourself. And our team kind of walks you through your situation, your goals, your objectives, your risk tolerances. These are the ones that we think you make the most sense for you, but you get to decide. So that's a brief overview of K Properties. Let's jump into it. The 721 exchange is an UPREIT exit strategy for 1031 exchange investors. So Section 1031 exchange, you're doing a like-kind exchange. You're selling an apartment building and you're exchanging into another apartment building, or selling an apartment building and exchanging into a commercial property, or commercial property into a piece of farm or ranch land. That's like-kind. Any type of property that is held for investment or business purposes is considered like-kind, and you can exchange into it. You can't do it with your personal residence or your primary residence. It could be a rental home that you've been renting out and you exchange into another rental home or into a commercial property, but it can't be a property that you're living in. Okay, so that's the Section 1031 exchange. The Section 721 exchange, basically the IRC 721 states that no gain or loss will be recognized when property is contributed to a partnership in exchange for an interest in the partnership. And that's that 721 exchange into a 721 exchange vehicle. It's tax deferred. No taxes are due. Okay, you're contributing your property for a proper or for operating partnership units in the partnership. Okay, and the important thing to note is Section 1031, when you do one of those, your CPA is going to fill out Form 8824 for you. And that's where you report, I did a 1031 exchange, I sold this, I exchanged into that. The Section 721 exchange is the same exact form, the Form 8824. And that's where you report, yes, I went from a property or a DST into a 721 exchange vehicle. So that's that same form. Not many people know about the 721 exchange. And the reason why is it's really been something that only institutions have done or very, very high net worth investors have done over the years. And the reason being is that say you own a 25 unit apartment building in Miami, and maybe it's worth $7 million, or Beverly Hills, or wherever your property is. Could be a duplex in Kansas, whatever it is. Large funds, right, or partnerships, or AKA REITs, or investment vehicles. These institutional investment vehicles, they don't want to buy a $1 million property or $5 million property typically. Okay, if they're buying apartments, they want to buy a $50 million building or a $100 million building. It's a much more efficient process for them to deploy capital. And so they're not going to offer individuals that have smaller price point deals, from a couple hundred grand, 5, 10, $15 million. They typically won't even offer you that option to do it, to contribute your property to their 721 vehicle and have shares in their partnership on a tax deferred basis, right? They're not going to do that. And so as a result, the 721 has been, used for very high net worth investors or families or real estate investment groups that may have a portfolio of apartments or portfolio of hotels. And a big institutional buyer will say, hey, we'll buy that at this price, but we're going to pay you through a 721 exchange in operating partnership units, or OP units, as we call them. And so you might contribute your $59 million apartment building to that large, REIT, and receive shares in their entire REIT. And you would potentially do that because of the diversification. You don't have all your eggs in that one $59 million apartment building's basket. You now have a portfolio of thousands of apartment units all over the country that you're diversified in. That's the traditional 721 exchange that investors, have utilized. And because it's really been for the large property owners, very large property owners, because the large institutional funds don't want a $1 million or a 500 grand or a $5 million property. Most people that know about the 1031 have never heard about the 721. So the strategy that we use is a two-step process. Okay, so essentially you sell your property, right? And it might be a $500,000 duplex. It might be a $19 million portfolio of single family homes, or whatever you're selling, right? You sell it, you do a 1031 exchange, your proceeds go to your qualified intermediary. And then from there, you exchange into DSTs, right? And that's, the offerings that are on the KPI1031.com marketplace. When you register, you can log in and view what's available, all different asset classes, multifamily, build for rent, housing communities, self-storage, medical buildings, industrial buildings, long-term net leases with, some of the largest companies in the world leasing those buildings. But you're able to exchange into those DSTs, right? And maybe you have $1 million and you do 4 different DSTs at $250,000 a piece. Okay, your 1031 exchange is now completed. At that point, then you're in DSTs. You have a diversified portfolio of DSTs. The problem that solves for is your tax bill was taken care of. Okay, you don't have that large federal and state and depreciation recapture and the net investment income tax, the Obamacare tax, which oftentimes, depending on your state and your tax bracket, could be 35, 40, 45% of your sale price going to Uncle Sam, right? So the clients that come to us, they have that problem. We're able to solve for that problem at K Properties, right? Through the 1031 into the DSTs. They also come to us with the problem of, hey, I'm at or near retirement. I'm tired of managing these apartment buildings. I'm tired of the tenants' toilets and trash, the blood, sweat, and tears. I'm tired of, the government telling me I can't raise rents on my tenants, or I can't evict somebody if they're not paying rent. I'm tired of that. And I don't want that risk anymore. And so they go into the Delaware Statutory Trust properties because at the end of the day, those have professional property and asset management in place, a whole team. So like I said, K Properties, we're working with 25 different sponsors and showing you their offerings and walking you through the potential pros, potential cons, the risk factors, the business plan of each one of the properties. Okay. And so those sponsor companies, right, are the ones actively managing the properties. And, like I said, K Properties, our sister company that I've co-founded is Cove Capital Investments. At Cove Capital, we have a team, a full team of asset managers, property managers, accountants, attorneys, paralegals, a full team of real estate operators. And they're working the properties every day, dealing with the tenants, dealing with collecting rent, dealing with any repairs or anything that comes up, dealing with paying property taxes, dealing with hiring vendors in whatever area. So they're doing the stuff that you do on your own with your apartment properties. And believe me, it's a full-time job. We have a full team dedicated to managing our portfolio at Cove Capital Investments. We've got almost 100 buildings in our portfolio, almost $1 billion of properties that our clients have exchanged into the Delaware Statutory Trust. Okay, so that's solving for those clients' problem of they don't want to actively manage their properties anymore. Okay, and then also clients that are worried about the over concentration risk. That's a big problem for a lot of clients that come to us. They go, listen, I've got a $5 million net worth, but this one property is worth $3.5 million that I have, wherever it is, this apartment building or this, commercial building or warehouse, or, that's a huge amount of my net worth. And I just, I'm nervous that the government's going to enact, something like more rent control, or in LA, they've got the mansion tax, or in New York City, all the, the rent subsidized, government stuff going on there. I'm worried what that's going to do to the value of my property. I'm tired of managing it anyways, and I need to be less concentrated in one property in one location. And, that's the problem that we're solving for with the Delaware Statutory Trust. We're building a portfolio going from one property through a 1031 exchange into a portfolio of DSTs where we might do 4, 5, 6 different offerings. And now instead of having 25 tenants, we've got 4,000 multifamily apartment tenants, and 900 self-storage tenants, and long-term leases with companies like FedEx, with Walgreens, CVS, 7-Eleven, okay, Amazon, some of the largest companies in the world that are contractually obligated to pay rent each and every month per the leases. Okay, that's that diversified portfolio that we're building to solve those problems for those investors. Another thing is that, the potential cash flow, it's based on in-place leases on these properties, no guarantees. But a lot of times clients are coming to us with anywhere return or cash on cash return that they're receiving on their equity in their property of 1 to 2, maybe 3% that they're receiving. And that's with them managing it and being over concentrated. When they exchange in the portfolio of DSTs, they're able to turn that from 1 to 2, 1 to 3% to anywhere from 4, 5, or 6+% return on their capital. Okay, and that's a projected return based on in-place leases, not guaranteed, but we're oftentimes doubling and tripling cash flow potential for our investors. Okay, so that's kind of the Delaware Statutory Trust and how that works. Now, the two-step process comes into play. So you sold for $1 million, you exchange into 4 different DSTs, and before going in, you'll know, oh, this DST has a 721 exchange potential exit strategy. And that's where you as an investor in the DST, you might own 3, 4% of that building. After a specified time period, typically a year or 2 is probably the fastest you'll see it. The sponsor will offer you the ability to, would you like to do a 721 exchange by contributing your 2 or 3% interest in this DST building to our operating partnership, okay, on a tax-deferred 721 exchange basis in exchange for operating partnership units, okay? And the reason why these sponsors like to do this again, is because you're not contributing your $1 million property to their operating partnership. You took your $1 million and maybe you put 250 grand into a $50 million apartment building, and that's the DST. And now they say, okay, that $50 million apartment building is a great candidate now for our 721 exchange vehicle. Okay, so that's the two-step process that typically wasn't available for smaller investors, right? Investing a couple hundred grand to $5-10 million really typically wasn't available. And so the DST is the vehicle that can get you to that 721 exchange. So you do that on a tax deferred basis in exchange for operating partnership units in that 721 vehicle. Now, it's interesting to note that not all 721 vehicles are the same. And that's how the K Properties team that we have, that, when you sign up, if you request a call, you'll get to speak to one of our advisors that's done, dozens and dozens and dozens of these 721 and 1031 DSTs. You'll get to talk to someone and even set up a call with myself or our president or one of our managing directors to discuss the nuances and the differences between the 721 vehicles that we have on our platform. Okay, because certain DSTs, they're what we call pre-designated 721. So if you go into that DST, the sponsor already says, yes, absolutely, we are calling this DST into our REIT. Okay, so you as the investor have to be comfortable that you're going to go into that REIT. I personally don't prefer those, okay, for my personal investments. And the reason why is because these large institutional REITs, their values can go up and down, right? I want to be able to look at that REIT at the time and decide, yes, this is a viable opportunity. I like this. I like the properties in it. I don't want to have to be forced to go into, a 721 vehicle. Okay. But we'll walk you through that. Okay. Here's what it looks like. Here's why it might make sense for certain clients, but it's pre-designated. You will be doing the 721. Okay. Other properties or other DSTs have optionality. Okay. And those are the ones that I particularly like, where the sponsor will say, we likely will be offering you the ability to do a 721 exchange, contribute your DST interest to our operating partnership on that tax deferred basis. However, you're going to get to make a choice. Okay. We actually just did this. So K Properties, a little backstory. We've been, again, specializing in this for nearly 2 decades. We're the largest provider direct with investors, working with investors, helping them look at all the different DST sponsors, all the different DST offerings, all the different 721 strategies. We're the largest in the country. Okay. And so because of that, we have a very large volume of business. And we, 10, 12, 15 years ago, the sponsors in the space, they did not have debt-free offerings, okay, for our investors. And, building my company, and kind of going through the great financial crisis and kind of seeing how that goes and studying history, studying, previous crises and crashes prior to that, I just saw that, hey, there's a need for debt-free deals that don't have leverage, because typically it's the leverage that messes up a real estate deal. It's the loan on it that messes up a real estate deal. And so, at that time, 10, 12, 15 years ago, 99% of the DST offerings in the space were leveraged, had loans on them, and they're, balloon mortgages with 5 or 10-year loans on them. And, I just kind of realized, hey, my clients that are at or near retirement, they don't need or want to have that extra risk of leverage on the property. Because there's a risk of foreclosure. And so, we went to a handful of the larger DST sponsors and said, hey, we're bringing you a lot of business. We would like you to create a custom DST offering just for our clients. But we'll bring all the equity. You manage it as a sponsor like normal. There's one caveat though. We don't want you to use any loans, no debt. Okay. Because personally, I'd be investing in these, and I'm a very risk averse investor, as well as many of our clients don't want that risk of foreclosure. And so we did, fast forward, in these custom offerings, $500-600 million of custom DSTs for our investors that were debt free. Okay. And I say all that because it basically, most real estate investors, institutional investors, they've got debt on their properties. I mean, if you read the news, the biggest names in real estate are handing back the keys on their buildings. They're walking away from hundreds and hundreds of millions of dollars because the markets change. And if they had been debt free on those buildings, they would not be getting foreclosed on by their lenders. And so that's what we're trying to solve for. The problem that many investors have is that a lot of people that specialize now in DSTs or, these big institutions, they put debt on everything and they encourage debt. And it can make sense. And if you have to replace debt in your 1031 exchange, we have offerings with leverage on the KPI 1031 marketplace. However, for those that don't want to have that risk, debt-free options are something that we really have championed and changed the industry in the DST space. But fast forward, back to the 721 and the various the DSCs that you choose. We're going to walk you through which ones have a forced 721s and which ones give you optionality. We just rolled up, I think it was $200 or $300 million of those custom DSTs that we had for our investors. They're debt free. We just did a 721 exchange roll up where they all were contributed to a 721 exchange vehicle. The investors went from one property and one location in that DST into a portfolio of 2 million square feet of properties, different asset classes all over the country. So much more diversified portfolio. And when we did that, we made sure that the investors had a choice. Okay. If you were in a property and you liked it, you liked the cash flow, and you decided, what, I want to, stay in this DST. I don't want to contribute to the 721. We gave investors a choice. They could stay and hold their DST interest. But the overwhelming majority, I think it was like 98.7% or something like that, opted, no, I want to contribute my DST to the operating partnership because I want that diversified portfolio. Okay. So that's something that we walk you through at K Properties is what's the business strategy and exit strategy for each of the DSTs. Am I forced to do a 721? Well, what if I don't like the REIT that's pulling it in? What if I think I don't like the assets in it? I don't like the debt structure. I don't like what it looks like. Well, if you choose that one, then you're forced. And that's why we will say, hey, choose one where they're likely to give you an option of, do I want to do a 721 or do I want to just stay in the DST? Because once the property sells, at that point, you can 1031 into another DST or anything else that you want to go into. Okay, so we will walk you through that and how it works. So another diagram here. So the DST property is contributed to the 721 vehicle, the operating partnership. It's a diversified portfolio of properties. Also, from there, the investors receive OP units, operating partnership units, and those are going to you as the owner of the DST. That's your consideration, the value that you're receiving for contributing your DST interest to the 721 vehicle. It's also important to note, and we're going to get into why investors do this, but one of the things to note is that with the K Properties team, again, we're going to walk you through the different 721 exit strategies, the plans of these DST sponsors that have them, okay, their offerings on our platform. And we'll walk you through also which ones of these, 721 vehicles, what they look like, right? Because certain sponsors, they might have a debt-free DST and it's planned to go into the 721, but the 721 vehicle is levered to the hilt. It's got a 65% loan to value that's only going up as interest rates go up and various other factors. And so basically that debt-free DST isn't really the greatest scenario for an investor that wants to stay debt-free. Okay. So we'll walk you through that. There's other 721 vehicles that are pretty much the majority of the 721 planned portfolio is debt-free. Okay. Where there's no loans on, 99% of the properties. And if you're in a debt-free DST that goes into there, you can feel comfortable. Okay. The 721 exit, yeah, they're going to give me a choice. Do I want to stay in my DST or do I want to become diversified in the portfolio? But the nice thing is in that portfolio, 99% of the buildings are debt-free. So we walk you through kind of the future. And that's, again, some of the backstory that others aren't able to do for investors. So with that, so why do investors utilize the 721 exchange? A, tax advantages. When you sell real estate, you're going to have capital gains taxes, depreciation recapture, Obamacare, surtax, the Medicare surtax. That's less capital for investment. If you do a 1031, you get to defer all those taxes. Same for the 721. If you do a 721, you get to defer all those taxes. Okay. So you can defer it using the 721 exchange into operating partnership units of the 721 vehicle. Okay. Another thing is diversification, and it's really important. With DSTs, a lot of the problem again we're solving for that a lot of our clients have is they're over concentrated in one different property. Okay, but with the DST, they get to go into 4 or 5 or 6 different properties or offerings that may have many different asset classes, locations, tenants, and they want to diversify because it's the prudent thing to do. But it is important to note that diversification does not guarantee profits, never guarantees profits, and it does not guarantee protection against losses. Okay. There's still risks when investing in any real estate, any DSTs, any 721s, owning your properties on your own. There's risks. And diversification does not remove the risks, but we do believe it's the prudent thing to do. Just like in your retirement portfolio, you don't just own 100% of your retirement portfolio as one stock, right? You have a spread out, you have a basket of stocks, and maybe the market goes up or down. But if one company and you're all invested in it goes bankrupt, you just lost all your money. And so that's, it's a prudent thing to do, but it does not guarantee profits or protection against losses. But one of the main reasons investors utilize the 721 exchange or choose to is because, well, A, they were oftentimes over concentrated in one property that they owned. They 1031 into DSTs, they lower their concentration risk by diversifying in 4, 5, 6 different DST properties. So you got a nice diversified portfolio. And then when the 721 is offered to them, they're able to say they had, $500,000 in one DST property, and you can contribute that to a portfolio of 2 million square feet with hundreds of tenants, hundreds of locations. That's adding more diversification. So people like that, and that's why they do it, to reduce concentration risk. So for example, say you owned a $500,000 DST interest in one FedEx leased industrial building. We own a number, I think it's 15 or 20 or so FedEx distribution facilities throughout the country that we've sponsored as DSTs at Cove Capital Investments, where investors, sold their duplex. They invested 500 grand into, this FedEx deal, nice long 10 or 15-year lease with FedEx, corporately guaranteed on the lease. So rent payments aren't guaranteed to investors, but as long as FedEx continues to stay around and honor their leases, which, they've continued to do, obviously past performance doesn't guarantee future results. However, investors like that. They go into the DST. They've got $500,000 in one FedEx leased industrial building. Okay. After a year or two, that investor, for example, is able to 721 exchange and contribute their $500,000 interest in that FedEx building into a diversified portfolio. Okay. And that's containing over 2 million square feet of industrial, multifamily, retail, medical, and mixed use properties all over the country. Okay. So that 500 grand is now diversified over, 2 million square feet of real estate, with tenants such as FedEx, Amazon, Frito-Lay, PepsiCo, Walgreens, CVS, and others. Okay. So that's why people like it, right? The 721 exchange. Income potential. So investors potentially will receive income generated through distributions to the holders of the OP units. And this is another thing, why we don't want to have we typically don't like the forced 721 exchange where the sponsor goes, we will be taking this DST and putting it into our REIT. Well, we don't know what the REIT looks like at that time. And so we want to have an option to look at it and say, yeah, I like this. I like that, this REIT is debt-free. They don't have any leverage on the REIT, because if the REIT has a lot of leverage and those loans are coming due in 3, 4, 5 years, then I want to know about that as an investor, and also I want my clients to know about that. And so at the end of the day, having an option, we really like that. And again, because when you're looking at income potential from the OP units, you want to be able to see, well, what kind of properties are in that REIT, right? What kind of asset classes? What's the debt look like? what is the viability of them being able to pay me a distribution? Okay. And that's again where we come in at K Properties, walking you through that, and helping you get comfortable with each one of the offerings, what the business plan is, what the risk factors are to your income potential. Okay. Um, the 721 vehicles, they do have the goal of increasing income potential to investors over time, and that's through accretive acquisitions as well as portfolio optimization. Investors will enjoy the income potential that is tax advantaged via depreciation and other write-offs to help shelter distributions. Okay, so that's another reason why investors like the 721 exchange. Appreciation potential. Investors are able to participate in potential appreciation, realize at the individual asset level as well as the enterprise value level. Okay, so the portfolio of properties may be sold to another buyer at a premium because they're able to buy 2 million square feet of properties in one transaction instead of having to piecemeal them together. And we've seen institutions pay a premium for that. Okay, so as an investor in that 721 vehicle, you have the potential for that enterprise value level premium. It's never guaranteed. We don't encourage investors investing just for the enterprise level potential. We want to look at the fundamentals of the 721 vehicle or the REIT. We want to look at the leverage of the REIT. We want to look at the lease terms, the asset classes, a number of different metrics investors need to take a look at, and we'll walk you through that. The nice thing also about the 721 potential is if you're doing a 1031 exchange, or say you go into the 721 today, right? Or you're going to be essentially dollar cost averaging into the market because these 721 vehicles typically are continuing to buy, okay, continuing to buy. So if the market has buying opportunities, even though your transaction was today or call it 2 years ago, whatever it was, you're going to be able to continue to take advantage of that because you're in the entire portfolio. So the 721 vehicles of UPREITs typically are taking, having new acquisitions to potentially enhance shareholder value. And then also the 721 exchange vehicle, they're oftentimes optimizing the portfolio. So they may sell an asset that may be underperforming, or maybe if the market changed, they can sell an asset and go into a new opportunity that is a more efficient use of that capital and increase the income potential as well as increase appreciation potential into new opportunities. So the 721 vehicle itself can do 1031 exchanges into new properties inside. Okay, so that's kind of the appreciation potential. Again, it's important, these are real estate investments, no guarantees with any real estate that you own or any investments that there's going to be appreciation. Property values could go down. You could lose money investing in real estate. So it's important to note that. And, again, each one of these offerings, our team's going to walk you through the pros, the cons, the business plan. But then also on top of that, we're going to give you the private placement memorandum, which is going to go through all the risk factors that you should read and understand and be comfortable with prior to investing. Liquidity potential. So the 721 vehicle may provide investors with the option of liquidity on a partial or full basis. Investors will have the option to liquidate a portion of their shares in combination with their tax planning strategies. Liquidity is a feature that many investors may never need or desire. However, knowing that it is available provides peace of mind and options for investors. So these 721 vehicles often have liquidity features. They are typically limited to 5% per quarter or per year of the fund value. Each offering is different. It'll walk through it. It's never guaranteed. Liquidity may be limited. For instance, if there's a stock market crash of 1929 and there's a run on the bank and everybody wants to get their money out of the 721 vehicle or the REIT, which we just saw with the bank failures in 2023, some of the largest REITs in the world, private REITs in the world, ended up, not being able to fulfill all their redemption requests. Okay, and the reason why they have that limit is because they don't want to have to fire sale buildings just because everybody wants their money, and then fire sale them into a bad market because then everybody loses. So they have a limited liquidity feature. It's there if you need it, potentially there, right? Like it's for limited circumstances. And so we do always encourage our clients, don't invest in any DST or REITs or any 721 vehicle unless you're willing to hold for the full life of the vehicle, which could be 5 or 10 years, maybe even longer, right? So don't invest if you think you need your money tomorrow. But this is a feature of the mini 721 vehicles that is a nice thing for somebody for an unforeseen circumstance that's potentially there. Estate planning. A lot of our clients, again, are coming to us with the problem of, I need an efficient way to pass this property to my heirs. And my heirs or my wife or, whoever it is doesn't want to manage the properties, doesn't want to have to deal with all that I do. How would they even do it? Managing these apartment buildings, dealing with the tenants, dealing with evictions, et cetera. How would they do it? And that's where with the 1031 and the DSTs, there's a professional property and asset management team in place doing that for your heirs. When you exchange into DSTs, your heirs get a full step up in basis. Capital gains taxes are eliminated forever. And those DSTs are passed to your heirs pursuant to your trust and will. If you go into the DSTs that do 721 exchanges, okay, upon your death, same thing. OP units can be equally split and either held or liquidated by the beneficiaries of the trust through that limited liquidity potential that we talked about. Your beneficiaries receive a step up in basis and can avoid capital gains taxes and depreciation recapture tax. So again, that efficient estate planning mechanism that a lot of our clients, the problem they have, they own these properties, their kids don't want to manage them, they don't want their wife to have to manage them, and they're ready to, or their husband have to manage them. A lot of our clients are females that have built very solid, sizable real estate portfolios, but they don't want to have to pass that on to their kids. And they want that efficient estate planning vehicle. And that's what this can potentially provide. So it allows investors through estate planning with the 721 to plan for the future with the opportunity to transfer wealth to heirs in a tax efficient manner and allow for individual flexibility when liquidated. So this is a quick, I'm going to go over this quickly. Hypothetical case study. Say you had $150,000 interest in a debt-free DST that owned a single tenant net lease FedEx distribution facility. The property is debt-free. Say FedEx has 9 years remaining on the lease. The DST is fine. With this strategy, in this hypothetical example, the sponsor is saying, hey, you can stay in that DST if you want. And then once we sell the building, you can 1031 out. Or if you want to contribute your 150 grand DST interest to this portfolio via the 721 exchange, you can, and you get to have that choice. You'd get full tax deferral via the 721 exchange. You get diversification instead of being in one FedEx building in one city, where FedEx probably will renew the lease. But if they don't, then you've got to backfill that space. There's tenant improvements, there's leasing commissions, there could be downtime, and that could be a suspension of cash flow or interruption of cash flow because there isn't a tenant there. And that's a risk, right? But if an investor wants to take that risk, they can stay. If they don't, then they can go, okay, I'll do the 721. And now I'm in a portfolio of 2.1 million square feet with 80 to 100 properties in it, all different companies, all different tenants, all different asset classes. You now have tenant exposure in 33 different states instead of a single tenant to pay rent, relying on that FedEx one building. The investor now has a diverse portfolio of tenants across different industries and businesses. You still have upside potential. The investor now has the ability to participate in the entire portfolio's appreciation potential and enterprise value. You've got income stream protection and enhancement. The investor now has many diverse streams of income from multiple tenants, buildings, asset classes, and geographic locations. You've got increased income potential. The 721 vehicle will have the goal of increasing income potential to investors over time through new acquisitions, selling properties, and portfolio optimization. You've got tax benefits. Investors will enjoy income potential that is tax advantaged via depreciation and other write-offs to help shelter distributions. You have liquidity, excuse me. You have liquidity potential. So like we were talking about before, the investor now has the ability to liquidate a portion or all of their shares at their discretion, right? The DST interest is relatively illiquid. Our team, we do have a secondary market for DST investors, whereby, because we're working with many DST buyers, we're doing 5, 10, 15, 20 different DST exchanges per week. And so we have the buyers in their 45 days wanting a 1031 into DSTs. So if you had a DST that you purchased through us or maybe through somebody else, we likely would have a buyer for it, right? There's no guarantee at what price, but we have that market through our investor pool, right? So, but a DST in itself is much more illiquid than a 721 vehicle that may have a liquidity feature built into the offering. And now that could be subject to fund liquidity provision as set forth in the PPM. Again, typically a small percentage, 5% or so of the outstanding shares. But it is an option for 721 investors that a lot of people like, right? And then lastly, estate planning benefits. Upon the investor's death, OP units can be equally split and either held or liquidated by your beneficiaries of your trust, as well as your beneficiaries will receive a step up in basis, allowing them to avoid capital gains taxes and depreciation recapture taxes forever. So that's kind of a quick case study. So we're coming to the end here. If you visit kpi1031.com, you're going to get free access. You're going to register for free access to our marketplace of 721 exchange UPREIT opportunities. If you'd like to, you can have a call with us to discuss the various ones, discuss which ones, the underlying 721 vehicle is leveraged, which ones have asset classes that have higher risk, which ones, we think make the most sense right now, which ones, are debt free. So, you get access to them all, and then you talk to us and we'll kind of walk you through those pros and cons of each one. We'll also give you access to a listing menu of both debt free and leveraged DSTs available for 1031 exchange. So again, accredited investors only, like I said earlier, but you'll get that access to the listings menu to see those different DST offerings. And that's typically on the KPI 1031 platform, 20 to 40 different DST offerings available for you to view and kind of compare and see, what makes sense for your situation. Again, debt-free and leveraged DST investments. We have free access to the marketplace of DSTs that we have. And that's, again, typically over 25 different DST sponsor companies that we've worked with in the past that we feel comfortable with their deals. There's still risk, could lose money investing in DSTs or 721s or real estate. But, a handful of the one we get approached all the time with new sponsors, new offerings that we just won't allow on our platform because of the risk, because of that nearly 2 decades that I've seen and our team has seen of, how these things have performed during various market cycles. And so, but 25 different DST sponsors. And again, Cove Capital Investments is a DST sponsor. That's our sister company. You don't have to invest with Cove Capital. That's totally fine. We had that. We created Cove Capital because, again, there weren't very many debt-free DSTs in the general market. We had to have sponsors create them for us as custom DSTs. And then from there, we said, you know what? Let's, build out the team. Let's bring in the asset managers, the property managers, the accountants, the attorneys, our CFO, build that team. And, fast forward, we have $1 billion of debt-free DSTs on behalf of, I think 1,600 investors at Cove Capital. And so, you'll see those offerings, but you're not beholden to them. You can invest in any one of the sponsors on the platform and we'll walk you through. But, and that's something that a lot of people don't do, like a lot of sponsors, if you talk to a sponsor, they're trying to get you to over concentrate oftentimes their one property or their 2 properties, right? We want to build a diversified portfolio. We don't want you having too much exposure to any one property, because that's already the problem that we're solving for our investors, is getting them out of their one property or, their one city where they have multiple properties into a diversified portfolio. So, so if you register at kpi1031.com, you'll get free access to those items. You also, like Alexandra said, you'll get a copy of my book, the first ever published book on Delaware Statutory Trust properties. You'll get the listings menu. You also get a subscription to the 1031 DST Digest. We're big on education here at K Properties. Webinars like this. We have weekly webinars. We have weekly conference calls. We have our blog on our site, tons of articles. We're regularly published, myself and team members, in large financial publications across the country. So we're big on education. We'd love to share with you kind of what we've learned over the years. And then lastly, we do educational events for our clients, dinners nationwide. We have one in New York City coming up, I think in a week or 2. We have one next week in San Diego. We just had one in Charlotte. So we have them all over the place. We'd love to have you come to one of those. And then also come and visit us here at our office. You get to meet the teams, meet the investor relation teams, meet our transaction teams, meet the advisors, and come out and see us. One quick example that I forgot to give earlier before I end this is we had a client that it was 2012 or 13 invested a couple $1 million with me into DST. And he told me, he said, hey, this gentleman was from the Midwest. He owned a portfolio of commercial properties. He said, this is a small deal. It's $2 million, but we have another portfolio and we will be selling it. Okay. It's about $200 million worth of properties and we will be selling it. I don't know if we'll work with you, but I wanted to test you out and see how this goes. And so he did that in 2012, 2013. Fast forward in 2019, he calls and he's very pleased with the opportunities that we had put him into. And he said, look, we're under contract. We're selling our entire $200 million portfolio. We're going to have about $120 million of equity, 60 million of it. We are going to 721 for OP units into I'm not going to say their name, but one of the largest institutional real estate buyers in the world, their portfolio. So he's 721, half of his equity into their portfolio. Okay. And the other half of his equity is about $64 million. He 1031 exchange into a portfolio of DSTs with us. So $64 million into DSTs, and he was buying $2, $3, $4 million chunks in 20 or so different DSTs. And so that's to say, that's going back to the beginning of the call, the 721 is typically for people like that, because that company, that fund wanted the entire $200 million portfolio, and they said, we'll let you 721 in. And he said, okay, I like the portfolio, I'll do it, but I only want to do it with half the equity. The other half of the equity is going to K Properties to do DST portfolios. Okay, so that was kind of his test investment, the $2 million from that one property that he exchanged. And that's something that we encourage our clients. DSTs, they can be used as a test investment. Say you have a $2, $3, $4 million property or 500 grand property, whatever it is, you want to sell it, you want a 1031 exchange, but you don't know when that'll be. It might be in a year or two. Do a test investment. Log in at kpi1031.com, 50 or 100 grand test investment, and you get to see how we work, how the process works, how it works with our team. And you go into one of the DSTs, and then you have a level of comfortability. So we have many, many clients that have done that over the years, and it's really helpful for them. So with that, I just wanted to say thanks again. I really appreciate it, Alexandra, and hope everybody enjoyed the presentation.
Yes, thank you so much for all the detail and examples as well. We do have a few questions that we'll go over. David Simon here asked quite a few. I'll go over some of the ones he asked here. What asset classes do you like for investors?
That's a great question. There's a number of asset classes that I think have some compelling opportunities right now. Just in general, buying opportunities right now are much better than 2 years ago. That's because of those rate hikes that we saw and the extreme softening of the economy in various sectors. So everything that we're buying, today is really on sale compared to what it was 2 years ago, right? And then also the fact that there's $2 trillion of commercial real estate debt and investment real estate debt that's coming due over the next 2 years. That's some serious buying opportunities. So in terms of asset classes, though, for me personally, I will never do a senior care deal. I will never do a hotel deal. Okay. I guess somebody could give it to me, or I could pay $10, but it's those asset classes historically get hit really, really hard in tough markets as well as in volatile times, right? I've just seen that over the years and studied about it before. And so we can get into that. But right now, what are we buying at Cove Capital? And then what are we placing clients in at K Properties on the marketplace? Multifamily. The problem with multifamily is pricing. Although it's better than 2 years ago, sellers just really haven't recognized and realized that their properties are not worth what they were 2 years ago. And so it's tough to find an opportunity. We're actually under contract to buy a 100-unit building in San Antonio right now. And definitely, we feel it's good pricing. The seller has a loan coming due. They're actually in they got like a 3-month extension from their lender. So they've got some serious needs to sell. And we think there's good opportunity there. But multifamily, we like self-storage. We like long-term net leases with some of the largest companies in the world. We, like I said, we have a lot of FedExes and various distribution facilities, Frito-Lay's, PepsiCo's, et cetera. What other asset classes? Medical buildings can be a good asset class right now. Some build for rent housing, we do that. I'm trying to think. Yeah, I mean, those are really, we like multi-tenant industrial. So single tenant industrial is great for the long-term leases, the credit quality of the tenants. Multi-tenant industrial is really great because we're able to find, value. A lot of the things, a lot of the multi-tenant deals, the rents could be below market rents. They're shorter term leases. And so we're going to take them to market. And that creates a potential value pop for our investors. Also, again, there's a lot of sellers of all the asset classes that have loans coming due very quickly. And so, but yeah, multi-tenant industrial, we really like that asset class right now. And then also multi-tenant retail, right? There has not been a lot of retail built over the years, right? With this e-commerce shift, et cetera. But it's still vacancy rates are very low in multi-tenant retail, right? And then we got grocery anchored retail, et cetera. And again, a lot of the tenants are paying, below market rents. And so we can go in there and work to bring them to market. A lot of the tenants will be on gross leases. We'll convert them to triple net. A lot of the tenants will throw some TI dollars at them to refresh and renew their space, change their facade, their elevation, and extend their leases. So we just took an anchor tenant, on a multi-tenant retail deal we bought back a year and a half ago. We just extended the anchor by 6 years. We just added 6 years to the term, and that's value for our investors. So it's all kind of the same stuff. Multifamily, we like build for rent, single tenant industrial, we like multi-tenant industrial, multi-tenant retail. Those are kind of our bread and butter that we see great opportunities with, but we feel that they're risk adjusted returns where some of these hotel deals or senior care deals that we see out there, it's like the same projected cash flow for investors, yet much more volatile in terms of historically how they've been. And those might be great. And we've got many clients that have owned hotels and senior care deals on their own, and they operated them, and that was their business. So many clients that have done that. But in terms of for us, what we're doing for our investors, we want to lower the risk potential. And so those are some of the asset classes. Long answer,
Well,
sorry.
no, that's an excellent, thorough answer, and also kind of goes along with another question that we had from Huang, which is how do we know our equity and income stream from the 721 is protected, secured, managed properly? And I think part of that you just answered, which is picking the right asset classes and the right assets that really have an opportunity and are going to essentially produce less risk, or at least that's the goal, right? If you want, you can expand on that too.
Yeah, I mean that's a great answer, Alexandra. I would also say for that question, like you don't know, right? You could lose all your money investing in a 721 or a DST. Like that's a reality. It's real estate. But that's again why our investors look to us, going, okay, you've done this thousands of times. You worked with all these sponsors. Which ones would you put your money in? I've been involved in 90 different deals. Personally, I just did, I don't know, 20 different 721 exchange investments myself, right? 2-3 months ago that I just completed for myself and for my family. So you don't know that you're going to be secure because there's no guarantees in real estate. And that's why you need somebody like us to walk you through. Here's how we look at this. Here are the risks. Here's how we mitigate the risks. We like this. We don't like that. This one might be okay, but we'd rather just do this. That's the whole dialogue that we have with our clients, because real estate has risk. And so, and then another thing is, staying debt free. If there's one thing that anybody gets out of this webinar today, don't use debt unless you have to. The $2 trillion of commercial real estate debt coming due, right, monthly or over the next 2 years, but it's hitting monthly maturities. Debt that was originated in 14, 15, and 16. Those borrowers lost a lot of money. A lot of them did. Some of them did fine, I'm sure. But if they bought their properties debt free, they would not be selling that asset into an inopportune environment where a group like Cove Capital is, out there buying on sale, right? We're buying properties from sellers that are distressed. And so that's another thing, also about being debt free as a sponsor at Cove Capital. We're awarded deals all the time by sellers that choose us, even though we're not the highest bidder, but because of our lack of a financing contingency in our offer, we're a
Mm.
debt-free buyer. We'll just close on the asset. We don't need to, secure financing. And so it just really provides some opportunities for us. But really, if you want to protect yourself as much as possible, investing in real estate, which real estate can go down in value, you can lose money in real estate. Really consider the debt-free opportunities, because there are risks, but you just don't have the risk of a lender foreclosure. And we're seeing a lot of those happen, not just, just in general commercial real estate, right? Read the news. The biggest and brightest minds of Wall Street, of all the best business schools, they're handing back the keys. They're losing hundreds of millions of dollars of their investors' equity because they made bad bets on real estate with large balloon mortgages that are all coming due. So,
Hmm. And I think that also might have answered one of David's other questions, which is, do we have the choice of investments? And I think that's part of the consultation process with you.
absolutely, absolutely. Every investor has a choice, right? And we oftentimes will have investors fly in, with their spouse or their kids or their CPA and attorney, and sit with us and just talk through the choices, talk through the options, weigh the various scenarios, the pros and cons, and look at all the risk factors, and um, put together a solution that makes sense for them, because ultimately each investor gets to choose. We'll share with you, like, hey, uh, for my personal exchange just recently, or my recent 721, or these clients that just invested, $2 million with us, or 20 million, whatever it is. This is what they chose and why. And this is why we think that it might make sense for your situation. But ultimately, each investor gets to choose. And that's kind of the whole dialogue.
Yeah, that is really nice to have that option. And then another question as well from Ken, how do you get your money out of the 721 vehicle later on?
Yeah, so that's that limited liquidity feature. Okay, and each one of the 721 vehicles will have that feature, typically in their private placement memorandum. Okay, the offering documents, and you basically just shoot an email to the investor relations department at that 721 sponsor, the vehicle. Say, hey, I'd like to liquidate. Say you exchanged in $1 million. You had $1 million in a DST. The DST went into the 721 vehicle. Now you have $1 million of OP units. You shoot an email. Hey, I'd like to liquidate, 300 grand of my $1 million holdings, right? If you're still within the redemption feature, which is that typically that 5% of outstanding share value per year, then, and they do it on a first come, first serve basis, then they'll have you fill out a form, and then you will receive your disbursement of that $300,000. It's important to note, though, that when you do that, you're subject to all your capital gains taxes, okay, and depreciation recapture, because you deferred your gain and going in through the 1031, then to the 721. Okay, it's all deferral. But then when you liquidate a portion of it, you do pay taxes on that. Okay, so that's why most of our clients end up staying in these things, because the whole reason why they did it in the first place was to defer taxes. But that limited liquidity feature, those are there, and they're nice for a rainy day. It's also, it's just something that investors should know. Hey, this is there, but it could be shut down. Again, the sponsor does not want to fire sale all the assets on um, whatever day the stock market crashed in 1929, right? That's not the right time to sell the portfolio just because everybody goes, I want my money. And that's why they have the redemption, liquidity feature with a gate on it, to protect the value of all the assets. But it's a simple process. A lot of people like that because, they don't have to liquidate their entire amount. They can keep the bulk of their gain deferred through the 721. And maybe if they need 50 or 100 grand, they can do a
Hmm.
exercise liquidity feature.
Oh, that's really good to know. And I think that might go along a little with another question here about the 721 exchange. Says, you mentioned we are OP. Are we a partnership as owner or LP position or shares?
Yeah, I mean, each one of the offerings is different, structured differently.
Mm.
But yeah, you're going to be an owner of the operating partnership. You have units of that. Typically, it'll be an LLC or an LP. Okay, ownership structure of the operating partnership. The one that I just did personally, they were it was an LLC, so we got units of the LLC in exchange for our DST interests. Okay, so they're all kind of different, but it's each one of these things is an entity, right? It's an entity used to hold title to real estate. So whether it's shares or units or beneficial interests, like in a DST or a trust, you get your pro rata portion of what you distributed of that entity that holds the title to the properties.
Thank you. That cleared it up. Elizabeth asking, how do you get out of a 1031 that has debt?
So, well, how do you get out of a 1031 DST that has debt is probably what maybe what she's thinking. Because I mean,
Perhaps,
if
yes.
you're 1031 on your own, say you bought a 20 unit building in Dallas, and you have a loan on it for $1 million. When you 1031 exchange out of that building, say it was a $2 million building with $1 million loan, the rule with the 1031 is you have to purchase equal or greater value. Okay, so you sell your $2 million building, you paid off your $1 million loan with the sales proceeds. Now you have $1 million of equity to go buy another property through a 1031 exchange. But per the rules, you have to purchase equal or greater value. You sold for 2 million, you've got to buy for 2 million. Okay. So when you take that $1 million to go buy your next property, or say you buy a DST, you have to have a 50% loan to value on that DST, because your $1 million down just buys you $2 million worth of the property. And we can run illustrations and show clients how this works on paper. It's conceptually, it's sometimes hard for clients to follow that, but you're replacing the debt on your own. If you buy a property on your own, you've got to buy 2 million of real estate, or through the DST, you're replacing the debt as well. Okay. And the thing to note is, if you exchange, a lot of clients will be debt free, and they don't have any loans on their mortgages. They're kind of at a point where they paid them all off. They're at or near retirement. They exchange into DSTs, and their financial planner didn't tell them, hey, you know what, this property you're going into has a 50% loan to value. So you just levered up your $1 million and bought $2 million worth of real estate in the DST. When that DST sells, you now have to purchase equal or greater value. So you can't go back to debt free. And that's why we really like, if somebody's debt free, to keep them debt free, so they don't have to replace debt later, because who knows what the financing markets are going to look like. I mean, it's a much different scenario today to get a loan than it was 2 years ago, right? So it just depends on the situation, but you do have to purchase equal or greater value, and that's where the debt can come into play. And our platform, we have a bunch of DST offerings that have debt on them for clients like that have to replace debt. But we can do some neat things where we can build them a portfolio that replaces debt with certain DSTs, but then we have 2 or 3 or 4 other DSTs that are debt free, and they still replace that equal or greater value, but they've gotten diversified into some debt free deals as well as some leverage deals. So some neat things that we can do for investors, and we can show each of the listeners those when they call in, and we kind of walk through everything.
Great. Lucia or Lucia has asked, would we be going from active to passive investment at the time of a 1031 or 721?
Yes, working, yeah, with the 1031 into the DSTs and then the DST to the 721, you're going from active to passive. And again, that's what, all the blood, sweat, and tears that you do on your own, turning units, leasing units, evicting tenants, working with your eviction attorneys, redoing the roof, redoing the parking lot, just all the stuff that, the leaky faucets, smoke detectors, batteries in the smoke detector, all that stuff that you do on your own. when you exchange into the DSTs and then the 721, that's all handled by the sponsor company. And that's the team of the asset managers, the property managers, the attorneys, et cetera, that we have that are doing all those daily things for you. So your sole responsibility as an investor in one of our DSTs or in one of the 721s is to one, check your bank account each month and see the distributions if they've hit, right? The monthly distributions that you're paid via ACH direct deposit. So check that monthly. Every quarter, you'll get a report on the property or the fund, how it's doing, kind of an update on it. So you can read that. And then annually, you'll get your tax filing information, which typically, is an operating statement on the DST side that shows your property's rental income, the expenses, the net income, debt service if there's a loan on it, and then it'll show for each one of those your percentage ownership of that property. So you might be 1% owner, and it'll break that down. Then you plug that into, well, you pass that to your CPA, and your CPA plugs it into Schedule E on the tax return, just like your rental properties are now. So yes, you're going from active to passive. You don't have to deal with the tenants. You don't have to deal with repairs, maintenance, any of those issues. And that's why so many of our clients that are kind of at or near retirement are wanting to do these. And then also we have many young clients that, I think my youngest client was like 25 years ago. He had just bought self-storage properties when he was 20 years old. He made a ton of money and he was starting other businesses. He didn't want to deal with managing the property, so he exchanged into the DSTs. So, but people that are tired of that active management, this is kind of that solution.
Yeah, absolutely. And I think that goes along with another question we receive, which is who are the companies and management of these DSTs?
Yeah, so the companies that manage these are real estate companies that a lot of them have been around for 10, 20, 50, 75 years. Okay, and these are real estate companies that have been buying and managing and selling real estate on behalf of the founders, the principals, as well as their investors for many, many years. And a number of the firms that when you log in to KPI1031.com and view the different offerings, these are names that are in the news all the time. Right. So some of these firms are very, very large institutional firms that you will recognize. And then there's others that are smaller kind of regional real estate players that you don't know, but you can see, oh, wow, they've got, $1 billion of properties under management and 2 million square feet, or they own 10,000 apartment units all over this particular area. So you kind of get to see it. Those are the companies. So large institutions and then kind of smaller regional real estate firms, still big companies, lots of staff, lots of team members, et cetera. You'll get to see those. And then from there, we'll walk you through our experience with each one of them and their various different offerings.
Great. And Lucia also asking here, what happens to previous depreciation?
So your basis, and again, I'm not a CPA or an attorney, so you want to talk to your own CPA and attorney for tax and legal advice. But generally, your basis carries forward with you. Okay, and that's why you have to keep deferring. You have to keep 1031 exchanging, is because if you just sell, then you have that the recapture tax on that depreciation amount, and so your basis continues to carry forward, and you defer. And that's the same thing when you sell an apartment building that you own and go into another apartment building, your basis carries forward with you. And then same for you sell your apartment building and exchange into DSTs, your basis carries forward with you and you're deferring the gain.
Beautiful. Okay. Amir also had a question here. He just put in, do we get an annual audited financial statement on DST after investments?
Yeah, it just depends on which one. Some of the firms do audits. The problem is that an audit is very expensive. And if it's a $10 million FedEx building and FedEx is paying, $400,000 a year in annual rent, to do that would really be paid for by the investors in the form of lower cash flow. Okay. Each one's different. A lot of these big REITs, yes, they have audits. Each one's different. But yeah, you'll get to see that when when you choose, like, how do they run their books? How does everything look? And you can look at past books. You can see, oh, here's how it looked. Here's an overview of everything. But everybody's different. And again, if it's a $5 billion REIT, then sure, they'll have audited, materials for you. But if it's a $5 million, you know, industrial warehouse with FedEx or Frito-Lay, you're not going to have that, just because it doesn't make any sense. It would be half the cash flow because the audit would be, 200 grand. So
Right, right. Well, we do have a few questions left. I know we are way over on time, Dwight. So I wanted to just have you take a look at the Q&A. If you can access it, let me know if you want to answer any, last questions. In the meantime, I do want to let you guys know that we are recording this. We are sending you the recording tomorrow. We will send you the slides. If you answered yes to the poll question to get that toolkit, it will be sent to you. If you did not get a chance to answer the poll, that's okay. Tomorrow, we will still send you another opportunity to opt in for that. And we'll also provide you with Dwight's contact information. So if you do want to set up a call and you want a consultation, you can talk to Dwight or someone on his team. They can really go through your specific situation. And I think that's really, the best next step. If any of this that you heard today sounded like a good idea, doesn't hurt to ask and find out a little bit more about how this might apply to you. So I hope you all learned something new today. And Dwight, do you see any other questions that you'd like to answer before we head out?
yeah, absolutely. There's one here. What can we expect as interest on investment? It's not interest, it's rental income.
Mm,
But the typical projected cash flow to investors based on in-place revenue, right? In-place leases on the DSTs as well as the 721 is typically anywhere from 4 to 6.5%. Okay, and each program's different. And again, it's rents, right? So if the tenants blow up, they go out of business, or if there's an eviction moratorium and nobody pays their rent at the apartment building, or it's not guaranteed, right? But the projected cash flow on in place rent and leases is typically 4 to 6.5%. And so we're going to build a portfolio where just because something's 4 doesn't mean it's bad, right? But we want to mix in a handful of deals so we can get to that target return rate that you're looking for. And again, a lot of our clients, they're making 1 to 2 or 1 to 3% on their current property, and they're over concentrated. They have a problem with that. They have a problem with having to deal with all the headaches of it themselves. So we can increase their cash flow potential, as well as solve for those problems for them.
mm,
But yeah,
absolutely.
I would just say, I really appreciate everybody. The questions were great. Log in to www.kpi1031.com. A lot of great educational articles on the blog post, and we'd love to help you out. So sign up for a consultation, and yeah. So thanks so much.
Okay.
Appreciate it,
Yeah.
Alexandra.
Thank you, Dwight. Thank you for staying a little extra. We really appreciate that. And again, we will be emailing you all tomorrow. And as you exit, please check the exit survey as well. I do read your comments and also love hearing your feedback and ideas for future webinars. We are also going to be opening up registration for AAOA's Rental Housing Conference this year in October. So you will see that in the exit survey as well. If you do want to receive more information about that, please click yes. We are looking forward to meeting some of you in person. So very excited to announce that event coming up. Keep an eye out for it and answer yes in the exit survey if you'd like to know more. And in the meantime, I hope you all have a wonderful week ahead. And Dwight, again, thank you so, so much for coming to speak to our group.
Absolutely. Thank you, everybody. Thanks, Alexandra. Take
All right,
care.
everyone. Bye.
Bye bye.